Financial markets are at a tipping point. Something unprecedented is unfolding in global metals markets, and most investors don't fully grasp the forces driving it. Chinese speculators, flush with cash and starved for reliable investment avenues, are pushing copper, gold, and silver to historic highs. We are watching an estimated $7 trillion in household deposits coming due this year, with no productive alternatives in sight. This capital is moving fast into commodities futures, creating extraordinary pressure. Let me be blunt. This dynamic is now the central factor in precious metals, more than Fed policy, inflation reports, or geopolitical noise. Why? Because when you have $7 trillion seeking yield in an economy where real estate looks risky, bank deposits are low yield, equities face regulatory uncertainty, and bonds remain subdued, that money must go somewhere. Currently, it is flowing into gold and silver. China's M2 money supply is growing at 8.5% annually, while nominal GDP has slowed to 3.9%. That leaves a 4.6% gap between money creation and economic output. Excess liquidity has to find a home. It does not stay idle. Today, the path of least resistance is the commodities futures markets. This is not speculation, it is fact. The People's Bank of China has been ensuring ample liquidity and low rates, but it cannot force compelling domestic investments. Real estate is in crisis. Fixed asset investment has contracted. Banks are extending minimal new credit. Where does capital go? Into financial assets, into metals, into futures. Silver prices have rebounded today. Market supply in Shanghai remains tight. Premiums are running 3,500 to 3,800 yuan per kilogram against TD. Some suppliers are holding firm at these levels, while others, concerned about potential premium declines, secured procurement at 2,300 to 2,400 per kilogram. In South China, self-pickup cargo is being offered at premiums of 2,400 per kilogram. Some are even slightly lowering premiums due to difficulty in completing high-premium transactions. Pay attention here. When premiums rise so high that physical transactions slow, it signals a limit. The futures market may ignore it, but the physical market is sending a warning. A slowdown in actual purchases at elevated premiums suggests current price levels may not be fully sustainable. In Shenzhen, one of China's largest physical metal markets, buyers are adopting a wait-and-see approach. Transactions are soft, procurement is cautious. This divergence is critical. Futures markets are surging on speculative liquidity. Physical markets are hesitant. One side will eventually adjust. Either futures prices come down or physical demand ramps up. Historically, it's usually the futures that correct. Now consider the structural driver behind this flood of liquidity. $7 trillion in Chinese household time deposits are maturing this year. That is a staggering sum. Deposits were accumulated during periods of real estate instability and underperforming equity markets. Safe, low yield, boring, but secure. Now, investors must decide where to allocate these funds. Real estate is unattractive. Bank deposits barely keep pace with inflation. Equities face regulatory pressure. Bond yields are muted. Gold and silver emerge as logical alternatives. Gold, in particular, carries cultural weight, trusted as a long-term store of value. This is not just about returns, it's about security. Gold-backed products in China have more than doubled in number over the last 2 years, with their total value rising 8-fold. This is a fundamental shift in household savings behavior, not a marginal reallocation, a structural transformation. But we cannot ignore risk. The divergence between futures and physical demand is elevated. Shanghai silver premiums are high, yet transactions are becoming challenging. Shenzhen shows declining procurement. Manufacturing buyers are scaling back purchases rather than absorb inflated costs. Traders show little intent to acquire large positions under high premiums. When paper markets surge while physical activity cools, eventually one adjusts. History suggests futures prices usually fall to meet physical reality, not the other way around. That does not mean a crash is imminent. It signals elevated risk, requiring careful positioning. Speculative fervor can persist, but the balance is delicate. The PBOC is walking a tightrope. They want growth, but are wary of bubbles. Aggressive easing could inflate commodity speculation further. Tightening could choke recovery. Targeted measures have been their preferred approach, but the current liquidity excess may exceed what tools can manage. Global context also matters. Manufacturing data and PMIs are moderating, not accelerating. China's 2026 GDP growth projections sit between 4.5% and 5%. Domestic consumption recovery is modest. Industrial buyers are sensitive to price. Futures markets may surge, but without industrial support, the move is fragile. Central banks globally maintain elevated interest rates, influencing liquidity and speculative appetite. Physical premiums remain the most reliable indicator. The Shanghai silver market shows slight compression after an overheated period. Transactions at extreme premiums have slowed. Shenzhen's sentiment is cautious. Buyers are stepping back. Futures may rise, but physical demand is digesting the gains. This is a warning. Consolidation or correction could precede the next leg up, or a larger repricing may be forming. The $7 trillion factor cannot be overstated. The decisions of millions of households will influence global metal prices for months, even years. Some funds will stay in deposits, some in equities, some in real estate, and a meaningful portion is flowing into gold and silver. Elevated premiums and growing gold-backed products confirm this. These are real capital flows, not sentiment. The key question? Sustainability. Will this pace continue, accelerate, or reverse? PBOC policy is pivotal. The bank must balance growth and speculative control, easing risks bubbles, tightening risks stifling recovery. Targeted measures historically prevail, but structural liquidity excess may overwhelm them. The gap between M2 growth and GDP growth ensures surplus funds keep chasing returns. Commodities and precious metals are the current outlet. Analyst opinions are divided. Some argue the rally will persist due to structural supply deficits. Copper mines age, new discoveries are rare, green transition demands metals, AI, data centers, and solar infrastructure require copper and silver. Others argue prices are unsustainable, absent industrial consumption growth. Futures markets show speculative dominance, while physical demand is soft. Both perspectives have merit. For long-term holders of physical metals, the Chinese liquidity tailwind strengthens the thesis. Supply constraints remain, cultural trust in gold persists. For short-term traders, elevated risk and divergence between paper and physical markets demand caution. Position sizing, risk management, and timing are critical. Momentum is driving prices, not pure fundamentals. Shanghai and Shenzhen premiums, futures open interest, volumes, and PBOC policy are the key indicators. Physical market conditions reveal real pressure points. Futures may lag or exaggerate reality. Watch flows in gold-backed products to assess structural trends. For practical implications, long-term holders are supported. Short-term traders must respect volatility. New entrants are buying momentum, not value, and should adjust position sizing accordingly. The next months will reveal whether Chinese household allocation accelerates, stabilizes, or reverses. PBOC decisions, manufacturing trends, and physical premium changes will shape outcomes. Understand that the same factors driving opportunity also create risk. $7 trillion in liquidity supports prices, but can move elsewhere if sentiment shifts. Divergence between paper and physical warns of instability, but does not guarantee a crash. PBOC constraints suggest this dynamic may persist, yet sudden policy changes could flip the scenario. Time horizon is critical. Long-term accumulation sees short-term volatility as noise. Traders operating on leverage must act carefully. The market is complex. Direction alone does not determine success. Position sizing, patience, and adherence to evidence matter most. Let's dig deeper into the implications of this liquidity flood. Chinese households are not acting randomly. They are strategic, culturally inclined toward precious metals, and extremely sensitive to perceived risk. Real estate has lost its aura of reliability. Bank deposits offer minimal yield. Equities remain volatile under regulatory scrutiny. Bonds provide virtually no incentive. The only viable alternatives are gold, silver, and other tangible commodities that hold intrinsic value. This is why the surge in futures activity is happening alongside elevated premiums in physical markets. The scale of this phenomenon cannot be understated. $7 trillion is not small money. Even a fractional allocation into precious metals can dramatically affect global supply-demand dynamics. Global silver mine production hovers around 800 million ounces per year, and gold production is roughly 100 million ounces. Small shifts in Chinese household allocation ripple across the world. Futures markets amplify these flows, creating rapid price movements. When the physical market absorbs even a fraction of this capital, prices move exponentially higher. Yet, there's a subtle warning here. The divergence between futures and physical metals highlights structural risk. Shanghai premiums may remain high at 3,500 to 3,800 yuan per kilogram, yet physical transactions are slowing. Shenzhen shows a cautious wait-and-see mentality. Industrial buyers, who typically drive stable demand, are hesitant to absorb inflated costs. They scale back procurement rather than accept artificially high prices. When the real economy resists, it signals a ceiling may be forming. Consider the psychology behind this. Paper markets react instantly to liquidity flows. Futures contracts and speculators amplify moves. Physical markets, by contrast, represent real supply and demand. They move slower, but provide the most reliable signal of sustainability. Currently, futures are surging, yet physical activity is hesitant. This gap cannot persist indefinitely. Either physical demand catches up, or futures prices will correct. History favors futures, adjusting downward to match reality, particularly when elevated premiums inhibit transactions. This sets the stage for heightened volatility. Speculators may continue pushing futures higher, driven by momentum, news headlines, and global liquidity chasing returns. Physical markets, however, dictate the ultimate limit. If transactions slow too much, the divergence resolves through a price adjustment, often swift and severe. The long-term holders are largely unaffected. They are accumulating physical assets for wealth preservation. Short-term traders, especially leveraged participants, face elevated risk in this environment. Now let EES examine the structural driver behind this massive liquidity push, the maturation of $7 trillion in household time deposits. These funds were accumulated over years of cautious saving, particularly in reaction to China's property market challenges. Developers defaulted, property values fell in many cities, and equity markets disappointed. Households seeking security parked funds in time deposits. Safe, predictable, low yield, but safe. Now, maturity forces a decision. Where will this capital go? Real estate is unattractive due to continued uncertainty. Bank deposits offer limited return. Stocks remain constrained by regulation and volatility. Bonds are uninspiring. Precious metals, gold and silver, emerge as rare, trusted alternatives. Gold carries not only financial value, but deep cultural trust as a store of wealth. This is not speculative hype. It is behavioral reality. The evidence is clear. Gold-backed financial products have more than doubled in quantity over 2 years, while total value has increased 8-fold. This is structural, not marginal. The sheer scale of capital entering precious metals markets is unprecedented. For silver, the implications are just as dramatic. Limited annual mine production means that even modest flows can move prices significantly. Futures markets amplify this effect. However, the risks must be acknowledged. The divergence between paper and physical markets creates fragility. Futures prices may be elevated, but actual physical transactions are slowing. Shanghai premiums remain high, yet buyers hesitate. Shenzhen shows declining procurement. Industrial buyers are reducing orders rather than absorbing inflated costs. This indicates the current speculative surge may exceed what the real economy can sustain. Policy dynamics are crucial here. The People's Bank of China faces an impossible balancing act. On one side, economic growth requires support. Sluggish consumption, weak fixed asset investment, and banking sector stress all favor easing. On the other, asset inflation from speculative flows in commodities is a concern. Aggressive easing could further inflate bubbles while tightening risks, choking off the fragile recovery. Historically, targeted liquidity measures prevail, but the structural excess of M2 over GDP indicates the current environment may exceed their toolkit. Global conditions compound the complexity. Central banks worldwide maintain elevated interest rates to control inflation. Manufacturing PMIs show moderation rather than acceleration. Chinese GDP growth projections for 2026 hover between 4.5% and 5%, with modest recovery in consumption. Industrial buyers remain price-sensitive, limiting speculative support. Futures markets may surge, yet without industrial demand backing prices, elevated risk persists. Premiums in Shanghai and Shenzhen remain the best barometer. After an overheated period, Shanghai silver premiums show signs of compression. Transactions at extreme levels are difficult. Shenzhen buyers adopt a cautious stance, waiting for clarity. Futures may continue upward momentum, but physical markets dictate sustainability. When futures outpace real transactions, corrections eventually occur. For investors, this means understanding risk and opportunity simultaneously. Long-term holders benefit from structural tailwinds, $7 trillion in liquidity, cultural trust in gold, and constrained supply support positions. Short-term traders must acknowledge elevated risk. Divergence between paper and physical markets implies potential reversals. Position sizing, stops, and patience are essential. Momentum is driving current price action, not fundamentals. Futures markets reflect speculative flows, while physical markets reflect real supply and demand. Observing premiums, trading volumes, and procurement trends provides clarity on the sustainability of gains. Gold-backed product flows in China indicate a structural shift in household savings behavior, supporting longer-term price stability, yet volatility is inevitable. The liquidity flood creates opportunity but also risk. Even modest shifts in sentiment or policy can trigger rapid price adjustments. The divergence between paper and physical signals where corrections may occur. Long-term accumulation remains sound, but leveraged short-term positions are highly exposed. The PBOC dilemma persists. Supporting growth while controlling speculative inflation is inherently difficult. Targeted measures may struggle to channel surplus liquidity toward productive investments. Until the gap between M2 growth and nominal GDP closes, surplus funds will chase returns wherever possible, primarily in commodities. Analyst opinions remain divided. Some argue structural deficits and industrial demand validate current levels. Copper scarcity, green transition needs, AI infrastructure all support higher prices. Others emphasize the speculative nature of the rally, divergence between futures and physical demand, and moderating manufacturing. Both positions are valid. Markets are complex, and outcomes cannot be predicted with certainty. Long-term holders should remain calm. Physical accumulation for wealth preservation is insulated from short-term speculative surges. Short-term traders should adjust exposure, respecting elevated volatility. Entry timing matters. Current prices reflect momentum rather than value. Buying momentum requires different risk management than purchasing undervalued assets. Key indicators include Shanghai and Shenzhen premiums, futures open interest, trading volumes, and PBOC policy signals. Physical market conditions provide real insight. Futures amplify sentiment but may lag true scarcity or demand. Observing premium trends and allocation flows informs actionable positioning. Practical implications. Long-term holders retain structural tailwinds. Short-term traders require caution, discipline, and attention to divergence. Momentum can drive prices higher but carries the risk of rapid corrections. Time horizon dictates strategy. Now let's examine what this all means for the immediate and medium-term outlook. Markets are driven by flows, not narratives. Right now, flows favor precious metals. $7 trillion in liquidity, cultural trust, constrained supply. These are powerful tailwinds. But these flows can reverse quickly if sentiment changes, policy shifts, or economic conditions disappoint. The divergence between paper and physical markets is your early warning system. Observe it closely. Shanghai premiums illustrate this perfectly. After an overheated run, transactions at 3,500 to 3,800 yuan per kilogram are becoming difficult. Buyers hesitate, waiting for confirmation of sustainability. Shenzhen's retail sentiment mirrors this cautious approach. Industrial buyers are scaling back procurement. Physical markets are telling you the speculative surge in futures may be approaching a limit. Futures markets may continue momentum-driven climbs, but physical constraints dictate sustainability. For traders, the implications are clear. Short-term momentum can persist, but volatility is elevated. Leverage is dangerous in this environment. Correct position sizing is essential. Stops must be respected. Long-term holders are largely insulated. They accumulate physical assets for wealth preservation, not short-term speculation. They can withstand swings between $70, $75, or $85 per ounce in silver, and equivalent movements in gold. The next several months will be critical. Chinese households will continue reallocating matured deposits. Some funds will flow to equities, some to real estate, but a meaningful portion is channeling into precious metals. The cumulative impact is massive. Even small percentages of $7 trillion create outsized effects on global supply-demand dynamics. This supports prices structurally, but also creates the conditions for sudden, sharp corrections if sentiment shifts. Policy decisions from the People's Bank of China are central to outcomes. Easing could stimulate continued allocation into commodities, supporting prices. Tightening or targeted interventions to cool speculation could cause abrupt retracement. Their historical approach favors targeted measures over broad rate cuts, but structural excess of M2 over GDP is challenging. The PBOC may struggle to redirect capital toward productive investment, leaving commodities as a natural recipient of surplus liquidity. Global conditions reinforce this tension. Central banks remain cautious. Elevated interest rates reduce speculative appetite. Moderating global manufacturing and mixed PMI signals limit industrial demand support. Sluggish Chinese GDP growth projections between 4.5% and 5% for 2026. Temper expectations for rapid consumption-driven price support. Industrial buyers remain cost-conscious, slowing procurement and reducing their absorption of inflated prices. Analyst perspectives diverge. Some cite structural deficits in supply, aging copper mines, limited new discoveries, green transition demand, AI and data center construction as fundamental reasons for continued price strength. Others emphasize speculative dominance, divergence from physical markets, moderating industrial demand, and regulatory uncertainty. Both are valid. Markets do not move linearly. They react to flows, sentiment, and policy. Long-term holders should remain steady. Physical accumulation provides a hedge against systemic risk and currency debasement. Short-term traders must respect volatility. Entry timing is critical. Current prices reflect momentum, not necessarily fundamental value. Buying momentum requires discipline, not the assumption of undervaluation. Observe key indicators. Physical premiums in Shanghai and Shenzhen, futures open interest, trading volumes, PBOC policy statements, global manufacturing trends, and capital flows into gold-backed products. Premium compression indicates cooling physical demand. Expanding premiums signal scarcity supporting price. Futures may surge, but physical markets dictate sustainability. Risk management is crucial. Short-term traders should eliminate leverage or reduce exposure. Even small reversals in speculative sentiment can trigger sharp corrections. Size positions appropriately. Stop-loss orders should be carefully placed. Avoid overcommitting capital that cannot withstand volatility. Momentum-driven environments are profitable but unforgiving. The $7 trillion liquidity flood is structural but not guaranteed to sustain uninterrupted. Any macroeconomic shock, policy shift, or sentiment reversal could redirect flows. China's maturing deposits represent unprecedented scale, but households can reassess allocation if returns disappoint. Retail behavior has historically oscillated between euphoric buying and panic selling. Precious metals are likely to experience the same human behavioral patterns. Physical market trends are your anchor. Elevated premiums and slowing transactions indicate speculative ceilings. Futures volatility may continue, but physical absorption is the true test. When divergence persists, corrections often follow. Monitor procurement patterns, delivery data, and premium fluctuations closely. These are actionable signals that provide insight beyond price charts. Global context cannot be ignored. Central banks' stance on inflation, interest rate policy, and economic growth will influence liquidity allocation. High rates may reduce speculative appetite. Lower rates could encourage continued flows into commodities. Industrial demand remains critical. Global manufacturing and green transition projects dictate long-term structural demand. AI infrastructure, data center construction, and electronics manufacturing continue to drive incremental need for silver and copper. Cultural factors reinforce tailwinds. Gold remains deeply trusted as a store of value in China. Households continue to favor tangible assets over financial instruments, perceived as risky or unreliable. This behavioral preference magnifies the impact of liquidity flows. Even modest allocations from retail households influence physical markets disproportionately due to constrained supply. For short-term traders, the divergence between paper and physical markets represents both risk and opportunity. Futures markets may continue upward momentum, driven by liquidity flows. But physical constraints act as a natural limiter. If futures prices overshoot physical reality, a correction becomes likely. Volatility is not a sign of weakness. It is a natural byproduct of structural imbalances amplified by speculative flows. Long-term holders benefit from a different perspective. Accumulating physical assets during this period aligns with wealth preservation strategies. Temporary fluctuations between $70 and $85 for silver, or equivalent movements for gold, are less critical. The strategic allocation of physical metals provides a hedge against systemic risks, currency debasement, and geopolitical uncertainty. The People's Bank of China remains a key variable. Policy adjustments could stabilize or disrupt these flows. Targeted liquidity measures have historically succeeded in directing capital, but structural excesses in M2 over GDP may render them less effective. Until the gap closes, surplus liquidity will continue seeking returns, primarily in commodities and precious metals. Global manufacturing trends provide further context. Moderating growth in industrial sectors tempers demand. PMI data, manufacturing capacity, and supply chain constraints all influence metals consumption. Elevated speculative activity in futures may not reflect actual industrial uptake. Monitoring industrial buyer behavior provides insight into sustainability. Practical guidance emerges from this analysis. Long-term holders remain positioned for structural tailwinds. Short-term traders should adjust exposure, eliminate leverage, and monitor key signals. Physical market activity provides the most reliable indicator of sustainability. Paper markets amplify sentiment but lag fundamental reality. Volatility is inherent and should be anticipated. Positioning strategy must align with time horizon. Accumulating physical metals for wealth preservation is sound. Trading momentum requires vigilance, discipline, and careful risk management. Entry timing, position sizing, and stop placement are critical. Ignoring these factors increases exposure to sharp corrections. The Chinese liquidity dynamic is ongoing. Households continue reallocating matured deposits. Structural tailwinds favor precious metals. Cultural trust in gold amplifies demand. Physical supply constraints remain real. Futures markets provide momentum, but require context from physical trends. Policy evolution from the PBOC will influence outcomes. Easing or tightening measures can accelerate or moderate speculative flows. Global economic conditions, interest rates, and industrial demand will impact metals absorption. Physical premiums are your early warning system. Observe them closely. Sentiment may shift quickly. $7 trillion is structural but not static. Retail behavior can reverse. Futures volatility may continue to present opportunities, but comes with elevated risk. Long-term accumulation remains advantageous. Short-term positions must be carefully managed. Momentum is powerful but unforgiving. In conclusion, we face a complex landscape. Structural liquidity flows support prices, but divergence between paper and physical markets elevates risk. PBOC policy, global economic conditions, and industrial demand will influence sustainability. Long-term holders remain insulated. Short-term traders require vigilance, discipline, and risk management. Premiums and physical trends provide actionable insight. The market is dynamic, and flows dictate direction. Chinese household reallocation, $7 trillion in liquidity, constrained supply, and cultural preference for precious metals create unprecedented tailwinds. Futures markets amplify sentiment, but do not dictate long-term reality. Physical absorption is the ultimate arbiter. Monitor trends, observe divergences, and adjust positions accordingly. This is John A.G. The dynamics are unprecedented. The risks are real. The opportunities are substantial. Long-term holders benefit from structural support. Short-term traders must respect volatility and divergence. Physical markets provide clarity. Futures markets amplify liquidity flows. Positioning and risk management are key. The Chinese liquidity flood is shaping global precious metals markets. $7 trillion in maturing deposits represents structural reallocation. Gold and silver benefit from cultural trust, constrained supply, and limited alternatives. Futures markets provide momentum, but must be interpreted alongside physical market data. Premiums, procurement trends, and transaction volume offer actionable insight. Understanding flows, divergence, and structural drivers is critical. Long-term accumulation aligns with wealth preservation. Short-term trading requires careful monitoring, discipline, and risk management. The People's Bank of China, global industrial demand, and macroeconomic conditions influence sustainability. Divergence between paper and physical signals elevated risk, but also highlights opportunity. Time horizon determines strategy. Momentum can continue, but physical absorption dictates limits. Volatility is inherent. $7 trillion of liquidity, cultural preference, constrained supply, and futures amplification create unprecedented dynamics. Observe, understand, and position accordingly.